What's going on, investors? Roger back again, and today we're going to take a look at a dividend aristocrat, AT&T. So it's currently trading at $27. It was down 1.6% in the trading day today. It actually jumped up 6% after its earnings announcement yesterday, and it's currently paying a $2 dividend, and its yield is sitting at 7 and about a half percent, we'll say. And basically, the thing with dividend stocks like AT&T is you're kind of buying them for their cash flow. So the revenues actually don't end up growing that much. And just the other day, AT&T's dividend was more like 10%. And when you get anything higher than, I say, around 4%, there's actually some risk, because as the stock price keeps decreasing, the dividend goes up. And you actually have to look at why the stock price is going down. And when you do have a really high dividend, it's kind of a red flag. So when you're looking at dividend stocks, there's something you want to look at. It's called the payout ratio. So the payout ratio is basically the dividend payment amount divided by your net income. In my opinion, it's probably not the best way to actually look at it. You might want to do dividend divided by cash flow, because something like AT&T actually has something called depreciation. Depreciation is a non-cash expense because it actually doesn't reduce cash. It's just an accounting term, and it's only reported on the income statement. And when you go to the cash flow statement, it's actually added back because it has no cash effect at all. And currently we're sitting at a 65% payout ratio. So that means 65% of AT&T's earnings are actually paid out as dividends. Then they have 35% left over, and that usually goes towards operations. So I'll point out a couple of key things with AT&T before you ever actually think about investing. So these are a couple things to actually note. So the first thing is their price to earnings. So this company actually lives and dies by its earnings reports. And as you can see, every time they report earnings, they either go up or down incrementally by a lot. So over here we have earnings. The next day they're up over, what is that, at least 10%. Then here they report earnings. Earnings weren't that good. Down another 10%. Right here, earnings down. The earnings were good, they go up. Earnings were bad, they go down. And right here we have the small jump for the most recent earnings. So that's something to keep in mind. So if you see between a 5 to 10% swing with AT&T and you're actually invested, don't get scared and just sell off, because as we see, this is a company, whenever earnings come out, they're either going to go up a lot or they're going to go down a lot. And we just saw this with the most recent earnings report, where AT&T was actually up 6%. So really long term, you're buying it for the dividend and not really growth in the stock price. And it's one of those more of those safe investments that investors are actually looking for. And the next thing we'll look at is something called leverage free cash flow. So as I said, AT&T is a company that you buy for the dividend, and AT&T actually has lots of debt. But when you actually look at it just from that sense, oh, I'm not going to buy it because it has a lot of debt, you have to actually account for how much cash flow they actually produce. So leverage free cash flow is basically cash flow after all their obligations are paid, such as debts. So over the past 10 years, their leverage free cash flow has actually been growing. So in that sense, their dividend is quite safe. And considering that we just got through the pandemic and they never got to cut their dividend, I actually see it as a pretty good value. So since 2011, they've grown their leverage free cash flow from 10 billion all the way up to 37 billion. And when we actually jump into their free cash flow statement, you'll see that how much cash flow they're actually generating compared to their income statement net income. So the next thing we'll do is actually jump straight into the financials. So free cash flow is one of the most important things when you're actually looking at AT&T, and they actually do a good job of actually breaking this down so it's actually easy for us to find. So in this case, free cash flow increased from 6.2 billion all the way down to 8.2 billion. And basically free cash flow is when you go on to your cash flow statement and you go add all the adjustments and you go down to the net cash provided by operating activities less capex, so capital expenditures, and that gives you free cash flow. So free cash flow is basically saying that this is all the cash that we have after we account for our operations and our capital expenditures. So the free cash flow we can use to pay things such as dividends. We can do things such as stock buybacks. So in this case, you always want to see a free cash flow that's increasing. But when you look over a 9 month period, we actually had a decline. But we can't be too harsh because we are in a pandemic, and the free cash flow actually held up pretty good compared to other companies. So when you actually go down from the 8.2, you less your dividends, you come down with $4.5 billion. And they actually give you the free cash flow dividend payout ratio. So we talked about earlier how it just gave you the payout ratio with actually net income, and that might not actually be the best way to actually look at it. And they actually do a really good job of giving you a really good explanation of the most common and the best way to actually do it with a company like AT&T. So you could kind of look at this as a KPI, and KPIs are key performance indicators. And it's actually really important to look at indicators that are specific to the company and the industry. You can't look at every company in the same way. So free cash flow payout ratio for AT&T was 45.2%, and the last quarter it was actually 60%. So that's an increase. You want a payout ratio that's actually lower, and the reason for this is because you want a ratio that doesn't end up taking too much of the company's cash paid out towards dividends. So let's say we had a payout ratio of 90%. That means there's only 10% left in the business each quarter or every year. And you actually don't want to see that. So when we actually have a decline in the payout ratio, that's actually a very good thing to see. But on a 9 month period, we actually increased by 3%. But quarterly, we're actually looking really good. The last two things we'll do is look at the cash flow statement and the balance sheet. So this is the cash flow statement. It gives you a 9 month period. Probably not the most ideal thing. We probably want to break it down into the quarterly basis, but we'll just work with what we have. So previous on 2019 on a 9 month ending, we had $12.2 billion in net income. And in 2020, we had $9.6 billion. So here are the operating activities. So depreciation was $21 billion. So that's a non-cash expense. So we're actually going to add that right back. And when you do all of these cash and non-cash adjustments, you come down to a net cash provided by operating activities. So this company produced $33 billion in cash, not accounting income, but cash. Then we're actually going to actually invest some of that money. So here's the capital expenditure. So if you do 33 billion minus the 13 billion, that gives you the free cash flow that we just talked about. But there's other investing activities that they have as well, and they're not too significant. So totaling they equal 13.7 billion. So not too much from the 13.2. So or if you want a more accurate number, you can actually do 33 billion minus the 13.7 billion to calculate your free cash flow, but it's not going to make too much of a difference. And the last section we have is financing activities. So this is where you'll see any payments of debt, dividends, if they did any share buybacks. So anything to do with financing. And in this case, we had a repayment of short-term borrowings of 7 billion. So it's a negative number. If it has brackets around it, that means it's a cash outflow. So the company paid $7 billion back. And over here, there's $31 billion of debt that we took on. There's no brackets, so that means it's positive. So $31 billion actually entered the company. And over here, we actually paid back 37 billion. So that gives you a $6 billion net. So that's basically saying we took on we paid $37 billion of debt, but we actually picked up $31 billion. So basically what that is, they actually probably refinanced some of their debt, got it at a lower interest rate. So it actually ends up working out for the company. And over here, they purchased some of their treasury stock back, and they actually issued some preferred stock here. So preferred stock usually comes with dividends. So now they're going to be paying dividends on this $3.8 billion worth of preferred stock that they actually issued. And over here for dividend investors, here's your most important line, dividends paid. So $11.2 billion were paid in dividends. And overall, so here it gives you net cash used in financing. We used $21 billion. And overall, we had a net decrease in cash and cash equivalents for the period of $2 billion. And we had cash and cash equivalents at the beginning of the year of 12 billion. And now at the end of the period, we have $9 billion left over, which will come over to our balance sheet. So the last thing we'll do is just take a quick look at the balance sheet. And here it is. So here's our cash and cash equivalents of 9.7 billion that we just saw on the cash flow statement. So everything on these statements is just going to make sense. there's no number that you can't find in each of the three statements. So if you actually have a good understanding of the statements, nothing you'll see will be like, oh, where did these numbers come from? So if you guys want to see videos on how to actually interpret these financial statements, leave a comment below and I'll actually make a video on that. So over here, we have total current assets of $49 billion. And this is a company that actually has a lot of assets. So if you come down to total assets, they have 538 billion. We have $143 billion of goodwill. So that's basically the difference between when they bought a company, how much they paid for it, and how much they were actually worth compared to, let's say, their assets. So the net asset value. And so you could kind of, goodwill is a non-cash expense as well. You can't really sell goodwill. No one's going to buy it. It's just an accounting term. So in reality, their total assets is actually 538 million less 143. It's kind of like depreciation. It doesn't really affect cash, but they do have property, plant and equipment of $128 billion. So just coming down to their liability section, they have debt maturing within 1 year of $5.8 billion. So if they were to pay that this year, they'd be left with $4 billion, which is pretty good. And we saw their cash flow. So they do have lots of cash to actually move around and pay debt off. They do have accounts payable due of $42 billion. And so that kind of raises a flag because we do only have $49 billion of assets and we have $42 billion of accounts payable that we're going to pay. But we saw the cash flow that they produce. They produce $30 billion in cash flow each year. So I'm not really too concerned with the debt number that they have. And long-term debt of $152 billion, it's actually just crazy. You never see companies with $152 billion in debt that aren't bankrupt. But this company's CFO just works the numbers so well and he just moves cash. They have strong free cash flow. And this is why the stock is actually not going to keep increasing in share appreciation. They have way too much debt. They pay way too much. Their dividend is actually way too much if you're trying to get stock appreciation, because 60% of the cash produced by the company is actually sucked out via dividend. So there's not much room for growth of stock price. And that's one of the reasons I've mentioned time and time again in this video, that you're buying it for the dividend. You're not going to see stock price appreciation. Even though we had the 6% increase, it was kind of just a one-time thing. Maybe in the next quarter, you're going to have a decrease of 6%. It's just how the stock is. And when you have $152 billion in debt, most of your cash flow produced is going to go into two places: paying the dividend and paying off the debt. And overall, guys, I think we'll leave it there. I feel like I've given a pretty high level overview on AT&T stock. So just final thoughts. It's currently trading at a PE of 8.84. It's a lot lower than it once traded at, but it's not the stock that it was, sorry, about 10 years ago. So that's something to keep in mind. You're buying it for the dividend. You're not going to get lots of stock price appreciation. This was just more of a one-time thing. Don't expect to see that every time. And from a price basis, like if you're buying it for the dividend, yeah, I think you're never really going to find a top or a bottom with the stock. It's always going to be trading on its earnings reports. So overall, guys, I think we'll leave it there. Like, comment, and subscribe. Let me know if you guys want to see any other videos. We have earnings season continuing from Monday. And if you guys want to see any particular companies, just let me know. Just leave a comment in the comment section, and I'll see you guys next time.